draw your attention to a letter that all of our managing partners, our strategic partners have signed that show their support towards Israel and towards the citizens of Israel. We're very proud of this relationship we have with so many of our friends. And two of these friends are here with us tonight. We have a very long-lasting relationship with them, over 10 years, David Parisier and Bik Bonpati. So without further ado, I'm going to ask each of them to introduce themselves. I'm just going to mention that there's a Q&A button that you can use to submit questions that you have, and we'll make sure to answer them either during the conversation or a little bit later. So I don't want to take any risks with guessing which one of you is older, but Bik, I think you'll go first.
Thanks, Asaf. Older and better looking, I hope.
Yeah, of course.
So, I'm talking about David Parisier, not myself. So I'm Bik Bonpati. I'm one of the founders of Greenridge. We're a UK, London-based commercial real estate investment company. We've changed our business model to being a fund manager of late, and that's going really very well. We focus on core plus assets. By that I mean assets that don't have any material development or letting risk in the UK. They're typically triple net leases, so all operational expenditure is the cost of the tenant. We started taking investor money from about 2015. We had a partnership with Profimex in 2011. So you really founded our business, Asaf and Elchanan. We now have investors from a Korean sovereign wealth fund, 2 US institutions, some GCC-based investors, some ultra-high net worths, and many Israelis. Our AUM currently is about $1 billion. Over the years, we've delivered a cash-on-cash yield of 8.3% per annum net of fees. What makes us different as a business is Paul, my business partner, and I really are very emotionally attached to our money, which we invest in every deal that we do with our partners. We launched our first blind pool fund last year. We were 45% oversubscribed on our first raise, and we're heading into our second round of fundraising. That's me. I could give you the longer version if you like, Asaf.
No, that was actually pretty long. David, what about you?
Hi, good afternoon. I'm David Parisier, and I'm the founder of Paradigm Partners. We are located in New York and specialize in multifamily investment in the tri-state metropolitan area. Founded the company 20 years ago, have been in the real estate business for now, I can't believe it, 37 years, and a combination of commercial and multifamily experience. Paradigm specializes in opportunistic value-add apartment strategies, and we also specialize in a geographic area very highly concentrated, the New York metropolitan and specifically Connecticut. Our current portfolio is just under $600 million in total assets, and we have roughly 2,000 units in the portfolio now. We've probably done close to $800 million of acquisitions over the past 20 years. $1.5 billion to $2 billion of total sort of financial transactions. Profimex and El and Asaf have and the whole team have been partners with us and invested with us since the founding of the company, way back to when we were just building and developing single-family homes. We are a vertically integrated firm. We self-manage all of the real estate that we own and acquire. We never do third-party management, and we do construction management, asset management, controlling, accounting, everything from within our Paradigm team, which is roughly 50 some odd people. We've always fought out the battle of high growth, warm markets and the hot markets of the United States with our northeastern markets, and we found that over time we perform just as well, if not better, which is one of the things we can talk about later in our Q&A. But nice to meet you.
That's a good segue to my first question. Both of you have mentioned your outstanding returns, 18, 19% IRR over the years, and I just want to make sure that everyone understands that this is an annual average return, 18, 19% year after year for many years for both of you. So those are really outstanding performance. What's your secret sauce? What do you attribute your success in generating these outstanding returns over such a long time?
David, you want to go first?
Tremendous luck. No, it's first of all multifamily, and Vic and I share something in common, that our investment criteria and what we do is in asset classes that are absolutely necessary, no matter what. And I'll speak about multifamily, but I think that is a key, and we're seeing it more so than we've ever seen it with the I won't call it the demise, but the softening of the vertical commercial office markets around our country and the world in some respects. And then we had retail during the pandemic, and even before that, we saw the softening in those markets, and those have recovered. And hotels, had a tremendous amount of weakness prior to COVID, during COVID, and there's been some recovery there. But multifamily is a must need. Everyone needs a place to live. And in our micro markets and throughout the United States and the world, there's a shortage of quality housing, period. And it's very hard to build more depending on where you are. So we've chosen markets that are very hard to build in, and that there is a shortage and strong demand for good multifamily housing. And compounded by interest rates, our business is stronger than it ever has been, because we can still borrow very efficiently, but people can't buy homes. So that's it in a nutshell. And it's just selection and team and track record and experience.
And big similar to Israel, multifamily is not a strong sector in the UK, a very small, relatively new phenomenon. What do you attribute your success to?
I'm going to echo what David says in terms of delivering a product that the market wants. But I think asset selection is one part of it. The other part of it is more operational, where I think robust processes are incredibly important. Good DD, due diligence, making sure that the real estate fundamentals are correct in terms of occupational demand, in terms of obsolescence factors and so on, and then really reading the market. But I think what mustn't be lost here is, without supportive investors, you don't have the equity to do the deals. So it's an enormous part of our business, which has only really three components. It's the equity from investors and ourselves, it's the debt from the wider market that you touched on, David, and it's the stock. And we're good at selecting the right stock, and we have supportive investors and pretty good processes. And I think that's what drives the returns.
I share that sentiment with Vic. It is about, I mentioned team, but team and some of the best deals we didn't do were the ones that we felt best about, because we were selective and we saw someone else do something we wouldn't have done and made the right decision.
So talking about making the right decisions, we're in a period of tremendous uncertainty. Started with COVID, increasing interest rates, inflation, the war in Ukraine, Russia, the ongoing election cycles in the UK, and then an election year in the US, which right now is predicting a change in government. How are you positioning your investment strategies and underwriting assumptions to account for these changing and unpredicted macro environment?
You want me to start on that one?
Golly. Caution is unfortunately a necessary approach to the environments we're in. COVID, the first 3 months of COVID was probably one of the more terrifying times I've had in the past 20 years. And you mind your knitting and you focus on team and focus internally. You certainly weren't looking for deals, but we found that navigating that was challenging for the first several months, and we also found that it created an incredible demand and opportunity. And in today's environment, it's far more complicated to me because of the capital markets environment. And we try to predict interest rates, and we try to project what's going to happen. And projecting rent growth and projecting operating expenses is far simpler than projecting externals and what's going to happen next in the world. So to navigate that, for better or for worse, we've seen a tremendous drop off in transactional activity. We are engaged in transactions. We bought one property last year, which we feel very strongly about, and we had to in order to execute. We're actually starting. We just came to terms on a new transaction that we'll be talking about in the very short term and sharing with Profimex team, because it just happened like literally a day ago. And even there, you have to feel very, very strongly, and you have to feel like you've got short-term, long-term, mid-term, stability, the ability to grow in an uncertain economy. But once again, we feel very strongly that there's a underpinning demand for for apartments. So if we feel that the product meets the mix, meets the demand, then it's just a financing strategy and creating the operational strategy. And we're conservative with financing. It's necessary these days. We like to go midterm to create an exit option to refinance that property. In these high interest rate environments, you need to take a midterm strategy, because you don't want to be exposed to uncertainty, but you also want to have the opportunity to unlock that financial structure as quickly as you can, reacting to changes in rates.
So we're going to talk about exit strategy in a moment, but before we do that, Vic, on your side of the pond, still part of Europe, how do things look underwriting in this uncertain environment?
And there's a short answer here, Saf, for us as a business. The short answer is we're not borrowing money right now. It's borrowing that drives you to have to sell at the wrong time. So not borrowing money is a simple answer. I mean, there's much more complexity to it, but I know time is short, so I won't go into too much. But I have a question on the premise of your question, which you make it sound like it's unusual that we're in a crisis, that there's 53 wars going on right now, and COVID and Brexit and all those other things. But if you look back over the last 50 years, can you think of a period of any substantial period where there hasn't been a crisis? I mean, in '87, we had Black Monday, and then there was Gulf War I, and then the Asian financial crisis, and then 9/11, and then there was the GFC, and so on and so on.
Don't forget the Russian financial crisis.
I mean, there are crises all the time. Let's call it polycrises. And David and I, and you less so, have been around the block a few times. We've got the grey hairs and the baldness to prove it. At least I have. And we should be expecting crises, and we should be structuring our businesses in a way where we anticipate that something's going to happen. Some bad thing's going to happen at some point in the next year or two, and let's make sure that we have our business in a way that we can cope with those. So not borrowing when things are difficult, I think, is a good one. Choosing asset classes well. COVID has changed everything. So in terms of how people occupy offices, how they occupy their homes, how they shop, and you have to adjust to those things. And it's like offices. Offices have become an unpopular segment for many, many investors. But we're finding there's a dislocation. The occupational demand for the right offices is very high. The investor demand is low, and that dislocation leads to opportunity. So I think there's lots of things one can do. These are just one or two.
So that's a great way to approach our next question. These opportunities, both of you on your sides of the globe, how do you approach sourcing these attractive investment opportunities? I think 20 years ago, there was a lot of conversation about off-market transactions. That was really sexy. We're the only one that got into this deal. In the UK, there's a lot of transparency around real estate transactions, much more than in the US, and absolutely much more than in Israel. We don't have a lot of transparency here. So how do you find these I don't want to call one in a kind, but very unique transactions?
Should I go first on this one, David?
Sure.
So I don't think, because of the level of transparency we have in the UK, and I think it's the most transparent real estate jurisdiction in the world, there are no off-market transactions. There are transactions which very few people have seen, but that's about the best you're going to get. I mean, fundamentally, real estate is a people business, which is why we all love it so much. And being in the business for 40 odd years, you create a network of people and connections, and we have boots on the ground and people in the team from different experiences who have different networks. I mean, as a result of which we see 2,500 to 3,000 deals, unique deals every year. With a blink, you eliminate 95% of those. That leaves 150. And from the 150, we bid on a few and buy a few. So I think it's just, once again, I hate to repeat, but it's about process. It's network. It's going through each one robustly, trying to see things that others haven't seen, and looking at the wider market dislocations and picking out the right ones. It's experience.
I agree wholeheartedly. You know, in when you're investing, in this whole 30 or 40 minutes we're spending together is about building wealth and investing, and sponsor. So, you know, BIC, you know, close to 40 years doing what we do and having seen up markets, down markets, but you know, there's lots of ways that deals get marketed or sold, and it's not about who sees them, it's about who buys them, and being the best buyer, and not being the best buyer by paying the most and doing things that are silly because you have no track record, because you've never closed a deal. But we've closed 30 some odd transactions over the past 20 years without ever faltering and doing what we say we're going to do. And the word of mouth amongst brokers is the most important part. And you may be competing against others, but you're competing against others' reputation as much as anything. And so the secret sauce is to do well, to behave honestly, to behave with integrity, to be very good at underwriting and very good at due diligence and execute. Because if you find things out too late and then you have to come back for a discount or come back and change your terms or whatever, you're never going to see that deal again from that broker. And that's where the due diligence and the experience and not getting in over your head the first time and the second time or any time is the way to be that buyer. And we see it all the time. We've bought many deals that went to market that we bought for less than they could have gotten because they had uncertainty with the other competitive buyers. Or we shied away from a deal that was off market and said, go to market. And you know what? We bought that same exact deal at that same exact price that we offered off market, on market, because it's about surety of closure.
And especially at a time like this with high interest rates, the ability to execute is extremely important. So cash is king. If the seller knows that you're going to be able to close on the deal because you have the resources for that and don't heavily depend on raising capital from someone else, and don't heavily depend on the borrowing market, then he has probably picks you as one of their top buyers. So now we own this asset and we have to do something with it. So generally we divide real estate strategies into three. Development, where we're trying to get kind of like these returns over 20% IRR, taking more risk, either ground up or some kind of a redevelopment. Core asset, where the assets are pretty much fully leased and very low risk. And then there's what both of you do in order to create wealth, which is what's called value add. Can you tell us a little bit about how you approach the strategy of value add, which really requires you to kick the dirt and raise your sleeves and work out there?
Sure, I'll jump on this one first, if that's okay. I'll go back to it. It's the team. We've been operating in the markets we operate in for 20 years. We have, I don't know, 100+ collective years of experience in our senior management team. Maybe close to 200. I haven't actually added it up recently, but but you make a good amount of your return when you buy the deal, first of all. And so it all goes back to, if we can't operate it, we self-manage everything. Our construction team, our property managers, our leasing personnel are involved in our due diligence. The people who are going to run the property once we buy it are involved in the due diligence. And if they don't feel comfortable with the prospective rents and what we're going to do from a capital improvements perspective to accelerate and grow those rents exponentially, and we think we can beat the competitive market at their own game by over improving versus the comp set and over managing, and marketing has gotten incredibly expensive in our industry, but that's a dollar that you can deploy exponentially in terms of the return. Then, you know, we stop the acquisition process. But once we own it, we're comfortable that we can deploy the capital necessary to do unit upgrades and amenity upgrades. Because, you know, I heard the other day on one of the other conversations you've had with partners, you know, amenities. That's the secret sauce in our business. You know, you can make make their units look nice, and, you know, the landscaping and the marketing, but marketing and amenities are two things that, you know, we think we've dialed in very well. So that's where we feel like we can really push rents, is delivering a product that makes people want to come home.
So, we spoke in the beginning a little bit about the AUM and the number of employees in each one of the firms. So even though your AUM is slightly higher than David's AUM, you actually have much less employees, and that has to do with the type of assets you invest in, and also the kind of management that is more typical to the UK, which is what we would call in the US triple net lease. Can you explain a little bit about the difference?
Yeah, let's put some context on this, Asaf. So if we look at our portfolio over the last 10 years, and we look at the market cycle that IPF report the data on, and we look at our returns and break them down into what was market-led and what was due to stuff that we did. So of the 18% IRR we've generated, about 40% is attributed to market. About 60% of the return we've generated is as a result of something we've done. Now, of course, in a triple net lease environment, there's no operational stuff to do that David has to do. Ours is much more about having asset management initiatives that are very specifically tailored to every asset we buy, whether that's improving the environmental credentials to make them more attractive for occupiers, or full refurbishments, as we did with a deal with Migdal on a couple of floors in Tanfield, or just simple lease ups. But I think if you select correctly what you want to do and how you want to achieve it, bearing in mind the requirements of the eventual user, it's a win. And there's no real secret sauce apart from just listening to the client, the tenant, and listening to the market.
I think everyone at this point has changed their perspective a little bit about their expectancy in the next few months. Until probably 6 months ago, there were more economists thinking about a very steep downturn and maybe even a steep recession. And now it seems like, at least in the US, we're talking about a soft landing. And yet it's going to be a different environment than the kind of frothy environment we were in between 2010 and the beginning of COVID in 2020. How are you changing some of your strategies to prepare for a more challenging capital markets environment, and maybe even employment and GDP growth?
Shall I start on that one, David?
Yes, please.
I think amongst the audience here, there's probably many investors who haven't invested in the UK and are predominantly focused on the US. And it's understandable. I mean, the US is a $20 trillion real estate market. The UK is one. The liquidity that the US might offer as a result of that is pretty good. The advantage of the UK is that we're an island. We can't build more land. And there is, by definition, constrained supply.
But it has never stopped you from going to other places and trying to capture them.
I don't think we're alone in that.
Touche.
I don't think we're late cycle in the UK. I think we've reached an inflection point and we're at the beginning of a new one. I think the US has some way to go, but David will comment on that. And there are some pretty clear indicators to support that assertion that we're in a new cycle in the UK. Swap rates, which is a tool we use to fix our interest rates and take away that risk, in July were 5.2%. Today, they're about 1.5% lower. So investors who are using debt to improve their returns are starting to come back into the market. And we're seeing that buyer pool increasing. The talk now is when rates will be cut. There's no talk in the UK of banking crises. And you know what? I think it's a time that's short to be able to buy things cheaply. I think that time is very short now in the UK.
Well, it's really the tale of two cities here. You know, we all had expectations. I know I did last year that by mid-2023 we'd be in a recession, and you know, the hyperinflation that we experienced coming out of 22 into 23 would dissipate, and we'd be, you know, softening. And when you feel like that's happening, you mind your business and you look for opportunities on the backside of that. So it didn't evolve. You know, we're seeing data that absolutely suggests that inflation has not gone away in our country. It happens to be apropos that we're having this call 2 hours before the Fed will let us know their mindset and how the Federal Reserve sees things. The leak from the Brain Trust says that they continue to be hyper vigilant against inflation. And the fact is, you know, we're all totally reactive because we have absolutely zero control over that overall landscape. But what we do have control over is, you know, is operating the real estate. And so we're very vigilant on collections. We're looking very closely at how we can continue to grow rents, and we've been very successful in that over the past 12 months, even though some of the competitive markets around the country have experienced lower overall rent growth, and they're talking about negative rent growth in some places. You know, we're continuing to see the demand and the credit quality. So focusing on credit quality, focusing on really the minding your knitting in bricks and sticks is become very important. And the other thing that you know, our investment class offers is a life raft financial structure with Fannie and Freddie. I have an aunt and uncle.
Can you say a few words about that for people who don't know what that means?
Yeah, so this is my Uncle Fred and my Aunt Fannie, who are two government service entities, GSEs, and they're the backbone lender in the multifamily industry. They are it's equivalent to a CMBS structure at the end of the day, because they do go sell their paper, but they only underwrite multifamily and only lend to multifamily. And on the other side, FHA lends to home buyers, and Fannie and Freddie also lend to single family home buyers. But for our industry, their mandate is to lend to housing providers. And if you're an affordable housing provider, it's even more so their mandate to create more affordable housing. And then their third mandate is to help with creating green projects. For the maybe 5 years, that was a very strong part of their lending platform, where you actually got discounted rates for participating in a green up strategy where you would do energy efficiency. That's become a little less prevalent in their mandates. But ultimately, if you can show some level of affordability in your real estate, in your apartment community, then you get a little bit of discounting on rates, and it meets their absolute mandate to lend. And these days they're lending in the 60 to 65, maybe 70%, where it was 80 to 85% over the past 10 years. But they are a tremendous source of liquidity. And so we took advantage of that throughout 2023. We did close to $100 million of refinancing and acquisition transactions exclusively using Fannie and Freddie and setting them off against each other. So it's a tremendous thing for us.
We're nearing the end of our conversation, and I have a few questions from participants. The first one is, what's the most important lesson or some of the most important lessons you've learned from your experience in real estate? And they actually asked that your answer cannot be the selection of our team. So it has to be something else.
I guess the three most important lessons: diversification of capital, location, asset class is a hedge on risk. I guess the second one is what a very famous Jewish banker said, Nathaniel Baron Rothschild: buy when the cannons are thundering and sell when the violins are playing. And I guess the third one is make sure your underwriting is robust and conservative.
I'm all in with everything Vic just said. But I'll add to that and really emphasize that the nature of what we do, and what we do, because we're both deploying our own personal financial resources now. And 20 years ago, when I had two sticks to rub together and I started this company, it was about treating my investors like the gold that they are. They are the gold that drives the business, and they're the most important part. So making sure that they're protected, making sure that they're comfortable, making sure that they get the returns and the preference and the security that they seek when they're investing with us is a major part of it. But then also the building wealth part is important. And one thing we haven't really touched on, which I'm going to end on, is we see building wealth as not a sort of short-term play for IRR returns. We see building wealth as creating multiple and expansion of your wealth. And creating a higher IRR over 2 years isn't creating wealth, it's creating return. And so that's one thing that we've heavily focused on in our investment strategy, is that we are medium to longer term, and we've owned some of our real estate for 20 years, but our investors have made 4 to 5 times their original investment and they still own the real estate. And so when you're talking creating wealth and creating, investing for that term, that's really sort of one of the things that I feel very strongly in, that, what I've learned in this great, wonderful ride that we've had. It's not just about seeking short-term returns. It's about, creating wealth through the asset structure.
And thank you both for bringing this up, because I think this is going to fit very well with what Limor, my colleague, is going to be speaking about in just a few minutes, which is about Circle 1 Fund number 6, which we're going to have many transactions from the two of you. We're very excited to see them. I have one specific question for each one of you. The first one for Bic: can you give some specific insight about UK rental submarket you find interesting?
I mean, I touched on this before, Asaf. If you look at the 6 big cities outside London, we've seen regional rental growth in offices of 4% per annum, which, if you believe the tales of woe that you read in the newspapers and on CNN and elsewhere, you would think that every office in the UK is empty. It's not. It's not. And it's surprising to see how robust that rental growth is in the context of what the capital markets have done. So that's my one. I mean, I could tell you longer ones, but that's a quick one.
And I have a feeling that the question was about residential rental. So if whoever asked the question wants to type it again and be more specific, you're welcome to. And if we answered it, then that's great. And David, my question to you is going to be about election this year. I know it's a very broad question, but how is it going to affect the real estate market, broadly speaking?
I don't think it will. Broadly speaking, the US election will, in the short term, up until the election, create quite a bit of uncertainty. And you know, we're all thinking about what the Federal Reserve will do, and there's two camps to that. One camp saying that they're going to manufacture a soft landing and provide statistics that are wonderful so that one person can pound their drum about how well they've done creating an economy that is, you know, that is healthy, but there's a lot of underlying issue that we're all seeing. And then the other side of it is we may really see the pickup of inflation again, and we may see some issues on the horizon. And there's no doubt that the consumer in the United States is stretched thin. So the election, I mean, from an economic perspective, I think that there'll be some impact. But I don't think you'll see winners or losers for years to come after the election, candidly. And our election this year is more about mindset as much as it is about economy. And it's unfortunate the type of candor and language that's being used from both sides. But there's a very strong feeling in our country that there's, just like in Israel, division. And I love the fact that the division has sort of been put aside slightly because everyone's rallied around a cause, which is the most important cause ever, the survival of the state of Israel and the people and the Jewish people in Israel. But our country is also going through that divisive period again. The last time, I remember coming to visit you in 2016, after the election. Maybe it was 2017 by that point. But
there's an election every year here, so just
right.
pick a year.
No, after our election when
Okay.
Trump was elected, and there was all this terror and fear and horror. And you know what? We had 4 great years of growth, and you're not going to know the winners and the losers for years to come. So it's about minding your business. And we see a lot of people who are basically waiting to see what happens, and then they'll deploy. We're in the same position. We're going to keep being opportunistic, and the economy is still strong enough that we feel very good about deploying into it. The consumer is something that we worry about because they have to pay our rent, but we don't see any signs yet of a tremendous weakening in credit quality. So, there's a lot of answers to that question. We could spend another 45 minutes.
Well, and I think we're going to keep on talking about this as we get closer to November. I want to thank both of you for your support, for the opportunities to invest with you, both of you for over 12 years. We're very excited about some of the opportunities coming up.
20 years.
20 years, sorry.
20 years.
And hopefully we see you in Israel pretty soon. Things will calm down here, and we'll go have hummus and arak together, and maybe even a beer. You guys are welcome to stay for the next part, which I'm going to hand over to Limol, but it's really going to test your Hebrew. So if you don't stay, we completely understand. Thanks again, and see you soon.